but something I feel like a lot of people don't stop to think about is if you go to sell that asset shortly after you purchase it, just a few years later, you immediately have to recapture all that depreciation and then pay capital gains on those returns. And of course, you could theoretically go redeploy that capital into a different investment to try to get more depreciation to make up for the depreciation you just had to recapture and the capital gains you had to pay.
What would you say is the number one secret to being an investor-focused passive investment or sponsor to help them invest?
Absolutely. So, I think there's a lot of groups out there that they're really focused on kind of a quick win and how can they I don't know, kind of synthetically maximize IRR. And on the surface, it may seem amazing if you can buy an asset and sell it a couple years later for what seems like a big IRR on paper. But at the end of the day, that's not necessarily the best outcome for the limited partner, for the passive investor. So that limited partner, they probably would prefer to stay in that deal for a longer period of time. And if that deal's going so great, like why wouldn't you want to stay in that deal? Sometimes turning those assets really quickly, it benefits the general partner because they generate more fee income on acquisition fees and disposition fees, and ultimately does not give the best overall return to that passive partner, and particularly from a risk adjusted and tax adjusted perspective. So you typically do cost segregation, accelerated depreciation, bonus depreciation when you buy one of these apartment buildings, single family homes, or if you're investing in any kind of real estate asset class there, you get this huge windfall of depreciation that you share with your investors. That I'm sure most listeners to this podcast are kind of familiar with how that works already. But something I feel like a lot of people don't stop to think about is if you go to sell that asset shortly after you purchase it, just a few years later, you immediately have to recapture all that depreciation and then pay capital gains on those returns. And of course, you could theoretically go redeploy that capital into a different investment to try to get more depreciation to make up for the depreciation you just had to recapture and the capital gains you had to pay. But it's a kind of a hamster wheel that you fall behind on each time. It's a good problem to have, but it's still a difficult problem to have. So our solution, it's very different. We target an indefinite hold period. We've actually never sold an asset. We return capital to our investors with a cash out refinance event, and then they stay in the deal forever. So this allows them to avoid the huge tax complications that come from constantly buying and selling assets. And our investors, I'll call more sophisticated investors that have been through that hamster wheel many times. They get a sense of relief when they invest in one of our vehicles. They're like, okay, so you're telling me that I can put my money here and I can hopefully catch up on the depreciation, recapture, and capital gains from the last couple deals I got out of, and I don't have to worry about this this capital event that's coming hopefully not for many years down the road. And we find it really serves our investors and puts their needs first.